Let's get more on this now with Dennis-Kenji Kipker. He's a research director at Cyberintelligence Institute. Welcome back to the program, Dennis. Now, we've had a wide range of earnings from big tech. How should we be interpreting this data, especially in terms of artificial intelligence?
So definitely you can see that the current everyone funds everyone AI cycle can persist for a while because it's anchored in real demand for computing. It means AI computing, chips, data centers, energy, networking, and because also the biggest platforms can finance it from operating cash flow, but it stops being defensible the moment the spending ceases to translate into durable revenue and margin expansion. So the main problem, or the key tension that we see here is that these firms are simultaneously suppliers and customers in the same ecosystem, which can inflate near-term growth optics while pushing the true payoff further into the future. And investors are therefore increasingly asked for proof that AI features lift pricing power, retention, and unit economics rather than just bigger capex.
Right, and how much longer can this boom last if there's no significant AI turnover?
So, in my opinion, the index concentration that you currently see absolutely raises the odds of a painful trap for many investors. Not because the companies are weak, but because concentration on investments converts broad market exposure into a high conviction of investors bet on a narrow set of shared assumptions. So AI monetization, regulatory outcomes, valuation levels, and the macro environment for long duration cash flows. And so when a small cluster is roughly a third of the S&P's 500, even modest multiple compression or any kind of synchronized earnings disappointments can drag passive portfolios and crowd out of the diversification people think they are getting. And it also makes market leadership more fragile because this rotation away from a few names becomes the whole index wobbling.
Right, and as you mentioned, there's a cycle of the same names investing into each other. So how sustainable is this for the broader market?
Generally speaking, I see some problems here. So when we compare the situation that we have now in 2026 with 2025, we can definitely say that 2025 has been a rough time for many of these big tech companies. So the outcomes for 2026 are, in my opinion, not that good. So in my opinion, what made the last year feel rough and regarding also the outcome is that the groups here stopped trading as a monolith and started trading as a set of very different businesses under one headline label. And this will continue for this year as well. After years of being treated as automatic winners, expectations were, of course, high, valuations were very sensitive, so the market rewarded the names that could show clear AI-linked acceleration or any kind of defensible narratives and penalized those where AI spending looked heavier than near-term payoff, where core businesses slowed or where competition and regulation clouded the story. So multiple analyses for this year point to a very sharp dispersion. So headline index gains for the cohort were disproportionately carried out by only a couple of these tech company members, while most lagged for broader S&P 500, creating the impression of a collective stumble, even as some stocks did very well.
A lot to digest there. Dennis-Kenji Kipker, thank you very much for your insights.